Welcome to Breaking News to Trading Moves.
Good to be here.
Today we're looking at a really key report, one of those big quarterly updates from a global player in consumer luxury.
Right, and these reports, they often give us a read on, well, on where things might be heading for other companies, particularly U.S.-listed ones.
Especially those with exposure to, say, consumer feelings over in Asia.
Yeah.
It's a bit of a bellwether.
Exactly. It's like getting an early look at global spending habits, particularly at the high end.
And the report in question is from LVMH Moet Hennessy Louis Vuitton, specifically their Q3 sales numbers.
That's the one.
And the big headline, the thing that caught everyone's attention, was that their Q3 sales actually returned to growth.
Yeah, a positive number after a bit of a rough patch.
And crucially, they pointed directly at improved demand coming out of mainland China as a key reason.
And that's the detail everyone zeroes in on, isn't it? Mainland China's luxury market has been volatile, let's say. So any sign of stabilization or actual growth there, people treat it as a really important signal for direction.
So what we want to do today is take that specific trend, this idea that the high-end consumers may be coming back, and figure out, okay, which U.S. companies might actually benefit from this?
Right. Who gets a tailwind from this change in spending?
And on the flip side, who might face some competitive pressure because money is maybe flowing back towards these prestige brands?
Yeah, it's a bit of a zero-sum game sometimes with consumer wallets.
Okay, so before we jump into the U.S. stocks, let's just nail down the LVMH numbers themselves. We need to understand the foundation here. What did they actually report for Q3?
Okay, so the top line number, Q3 sales were up 1%. 1% year over year.
1%, which, doesn't immediately sound earth-shattering.
No, in isolation, maybe not. But the context here is everything. This was their first quarter showing year-over-year growth in this entire financial period of 2025.
Okay, so it's about the change in direction.
Exactly. It's a signal. It suggests things might be stabilizing for the whole luxury sector after, several quarters that were pretty soft, maybe even saw contractions for some. The trajectory, as you said, seems to be changing.
Right. Trajectory. So if the overall growth was just that 1%, we need to dig a bit deeper. Where did that actually come from geographically?
Yeah, absolutely. You got to follow the money, or the euros in this case. According to their CFO, the overall improvement was really driven by Asia, if you exclude Japan.
Okay, Asia ex Japan.
But the really critical detail within that was mainland China. The official word was that the trend there turned positive.
Turned positive. That's the key phrase then.
That's the catalyst, really, for a lot of the market reaction we're talking about. For months, the story's been about Chinese consumers, pulling back, maybe spending more cautiously, shifting where they spend. This report kind of pushes back against that narrative. It suggests that, at least at the very high end, the consumer there is maybe feeling ready to start buying those high-value status items again.
Okay, let's zoom in even more. Their biggest division, fashion and leather goods. Louis Vuitton, Dior, the real powerhouses. How did that specific segment do if overall sales were up just 1%?
Right, good question. So that specific segment, fashion and leather goods, if you look year over year, it was actually still down slightly.
Oh, okay, so still negative compared to last year.
Yes, year over year. But, and this is the crucial bit, you have to look at the momentum. How did Q3 compare to the previous quarter, Q2, sequentially?
Right, the quarter-on-quarter change.
Exactly. And the sequential performance, Q3 versus Q2, showed a noticeable improvement. It accelerated.
Okay, so even though it was down year on year, it was getting better compared to just 3 months earlier.
Precisely, and that's the technical detail that gets analysts excited. It suggests that the willingness of consumers to actually buy these expensive items, especially at full price, was picking up speed as the quarter went on.
Gotcha. So the trend within the quarter was positive.
Right, and when you see momentum building like that, investors start forecasting, okay, maybe Q4 will reflect that acceleration more strongly, even if the absolute year-over-year number hasn't quite caught up yet.
Okay, that makes sense. So investors are looking forward, focusing on the acceleration, not the lagging year-over-year number.
That's generally how markets price things in, yes. They're forward-looking.
So let's talk about why LVMH matters so much beyond its own results, this sort of proxy effect. How does one big French company become such a barometer for stocks listed over here in the U.S.?
Well, LVMH is, it's pretty much the undisputed leader in the luxury sector. The sheer scale of it, the number of brands they own across different categories, fashion, leather, watches, jewelry, even wine and spirits.
Yeah, they're everywhere.
And their global footprint is massive. So their performance really does act as a pretty reliable proxy for the health of the high-end consumer globally.
So when they stabilize,
When the bellwether stabilizes, and especially when they point to renewed spending in a key market like China, that confidence tends to spill over.
okay,
It gives other companies and investors a bit of external validation. It suggests the overall environment for high-end discretionary spending is maybe finding a floor or even improving.
and that's important whether you're selling, I don't know, expensive coats or...
Or cosmetics, or even casino chips, exactly. If you rely on consumers who have a lot of disposable income and are willing to spend it, LVMH's results give you a read on that consumer's mood.
Basically, if people are buying Louis Vuitton bags at full price again,
Yeah.
it signals they have the confidence, maybe the cash flow, to spend on those aspirational high-status things.
You got it. And that sets the stage for thinking about who benefits from that renewed confidence. It signals what the market often calls the high-end rotation.
High-end rotation. Okay.
The idea that discretionary spending is moving back towards prestige items and maybe away from, say, value or discount options.
All right. Let's move into section 2 then. Let's
Yeah.
talk winners. Who benefits from this high-end rotation? The idea is that this aspirational spending is flowing back towards full-price, prestige stuff.
Right.
So the most obvious place to start seems to be U.S. companies in luxury and premium apparel and accessories.
Yeah, that's the direct read-through. These are companies that share a very similar customer profile and, product price points with LVMH's core brands.
So the better Chinese demand, the generally better feeling about the sector,
Yes,
that should help them.
absolutely. It's expected to boost their full-price sales, which is key. And also maybe their wholesale orders, the orders they get from department stores and other retailers.
And why is full-price selling so important here?
Oh, it's huge for margins, selling something at full price versus having to mark it down. I mean, the difference in operating margin can be massive. You could be talking high single digits versus, mid double digits. This is a big swing.
Okay, so let's name some names. Who in the U.S. market is really leveraged to this kind of renewed luxury spending?
Well, a classic name here is Ralph Lauren, ticker RL.
RL.
They've put a lot of effort into elevating their brand image globally, focusing on that sort of classic, high-end American style. That resonates well internationally, particularly with luxury buyers. So a better environment for prestige spending really helps validate their strategy of sticking to full-price selling.
Makes sense.
Yeah.
What about companies that have maybe a mix of brands, not just pure luxury?
Yeah, you could look at PVH, ticker PVH,
PVH, they own?
Calvin Klein and Tommy Hilfiger.
Yeah.
Big global names. Maybe not quite at the LVMH tier across the board, but they definitely command premium pricing and have huge global visibility.
Oh, yeah.
So their business, both selling directly to consumers and through wholesale partners, is pretty sensitive to spending trends in Asia, especially those wholesale channels that stock their stuff overseas. Renewed demand helps them shift inventory.
Got it. And then you mentioned accessories earlier. Any specialists there?
Sure. You could look at TPR, ticker TPR.
TPR, that's the parent company of...
Coach and Kate Spade primarily. They're really strong in handbags, leather goods, accessories. Those are categories that tend to see a pretty immediate pickup when consumer confidence in the luxury space improves.
Right. People maybe buy an accessory as an entry point.
Sometimes, yeah. And again, for TPR, the key isn't just selling more bags, it's selling them at full price, without discounts. That's where they really make their money, leveraging those higher margins.
Okay, so apparel and accessories are clear winners. Moving on from what people wear to maybe how they look. The next category you flagged is prestige beauty, especially companies with strong China and travel retail links.
Exactly. There's a strong connection here.
Why is beauty so closely tied to luxury fashion? Is it the same customer?
Largely, yes. It's a very similar consumer mindset. The person buying a high-end handbag is often the same person willing to spend, $100 or more on a face cream or premium makeup.
Okay.
Beauty is often seen as sort of an accessible luxury. And this sector gets a double boost from a rebound in Chinese spending and also increased international travel.
Travel retail, duty-free shops.
Exactly. Premium beauty products have very high margins, and they rely heavily on those duty-free sales channels in airports and travel hubs. So if LVMH is seeing improvement, it implies there's probably more foot traffic, healthier traffic at those high-end beauty counters around the world.
So which U.S. beauty giants are best positioned to capture this?
Well, the big one is Estee Lauder, ticker EL.
EL, a powerhouse.
Absolutely, especially in Asia. Their skincare brands like La Mer or Estee Lauder itself are dominant at the high end there. Their financial results are known to be really closely tied to the health of the Chinese consumer and what's happening in travel retail. So they're one of the most direct U.S. beneficiaries you could point to from this LVMH update.
Okay, Estee Lauder, EL, anyone else major in that space?
You could also look up Coty, ticker COTY.
COTY.
Right. Now, Coty's portfolio is a bit broader. It includes some mass market brands too, but their prestige division is really important for them. Think high-end fragrances, brands like Gucci Beauty, Burberry Beauty, Lancaster Skincare. They also rely on strong sales of those premium products. When the luxury consumer feels confident, they buy those high-margin perfumes and cosmetics, and that gives Coty's prestige business a real lift.
Okay, so apparel, accessories, beauty. Our final category of winners seems to follow the money, literally. Macau, cross-border leisure, and even payment networks. How does this all connect?
Yeah, this is about tracing where the actual transactions happen once that consumer confidence returns.
Right.
When someone, a high net worth individual feels good enough to buy an expensive watch or bag, they also tend to spend more on high-end experiences like travel and entertainment.
Right.
So a recovery among those high-spending Chinese consumers tends to boost activity in places like Macau, both the VIP gaming side and what they call premium mass.
Premium mass, what's that exactly?
It's basically high-spending leisure travelers. They might not be the ultra-high rollers, the VIPs, but they spend a lot on nice hotel rooms, fancy dinners, shopping in the resorts, and yes, gambling, but maybe at slightly lower stakes than the true VIPs.
Okay, and this LVMH report suggests those premium mass consumers are coming back.
That's the read-through, yes. LVMH's data supports the idea that this segment, which is very profitable for the casinos, is feeling more confident, and it also encourages more cross-border travel and shopping in general.
So let's focus on the casino operators first. Which U.S.-listed companies have big Macau exposure?
The two main ones are Wynn Resorts, ticker WYNN,
WYNN.
and Las Vegas Sands, ticker LVSS.
LVS, okay.
Both are heavily leveraged to the Macau market. Their fortunes really rise and fall with what happens there. And like we said, growth comes from both the true VIPs and this important premium mass segment. LVMH's report gives hope that the premium mass segment is reviving.
Okay, Wynn and LVS. And then you mentioned payment networks. How do they fit in? When people travel and spend on luxury goods or casino trips, someone has to process the payment, right?
Right. Visa? MasterCard.
Yeah.
Exactly. And think about the transaction value. These networks, like Visa ticker V and MasterCard ticker MA, they typically charge fees based on a percentage of the transaction amount. It's called interchange.
Ah, okay. So bigger purchases mean bigger fees for them.
Precisely. When someone uses, say, a premium credit card to buy a $10,000 handbag in Paris or pays for a luxury suite in Macau, that transaction generates significantly more fee revenue for Visa or MasterCard than, buying groceries.
Right, makes sense.
So an increase in cross-border travel, and specifically high-value discretionary spending, luxury goods, high-end hotels, entertainment that's basically the sweet spot for V and MA,
Good.
they benefit from higher transaction volumes, yes, but critically also higher average transaction values, which boosts their revenue.
So LVMH doing well is almost like a leading indicator for the transaction health flowing through Visa and MasterCard globally.
You could definitely see it that way, yeah. The correlation tends to be pretty strong because, well, they're processing the payments for the very same affluent consumers that LVMH just confirmed are opening their wallets again.
Okay, so we've mapped out the winners, the companies riding this high-end rotation. But now we need to look at the other side of the coin.
Right. Where does the pressure build?
When spending rotates so clearly towards the high end, it often means money is being pulled from somewhere else. That creates headwinds for companies serving, say, the mid-tier or the value end of the market.
Yeah, it's that zero-sum aspect of the consumer wallet like we touched on earlier. If a luxury buyer decides, okay, I'm going to splurge on this prestige item, that money often have to come from somewhere. Maybe savings, maybe delaying other purchases.
Or maybe trading down on everyday items.
Could be. But one of the most direct pressure points is usually felt by the off-price retailers.
Off-price, you mean like TJ Maxx, Ross?
Exactly. Companies like TJX and Ross stores, their whole model relies on getting branded goods, often overflow inventory from full-price retailers, and selling them at a significant discount.
Okay, so how does LVMH having a good quarter selling stuff at full price hurt them? It seems indirect.
It hits their supply chain, basically.
Hmm.
The mechanics are important here. Off-price retailers thrive when full-price retailers make mistakes, order too much, have styles that don't sell through.
Right, they need that excess inventory.
Precisely. So if luxury and premium brands, whether it's LVMH's brands or maybe Ralph Lauren, PVH, those guys we mentioned earlier, if they're successfully selling most of their merchandise at full price,
Then there's less overflow.
exactly. The supply of high-quality, desirable branded goods available for the off-price channel just shrinks. That makes it harder for TJX or Ross to get the kind of inventory that really draws customers in.
So their product mix might get worse.
It could, yeah. They might end up with less exciting stuff, or maybe they have to pay more to acquire the limited good overflow that is available, which would squeeze their own profit margins.
And isn't there also a demand-side issue if people are buying full-price luxury?
That's the other hit, exactly. The aspirational shopper, the person who might have gone to Ross or TJ Maxx hoping to find a discounted designer piece. If they're now feeling confident enough to just buy the full price item they really wanted in the first place, they might skip the off-price store altogether. So off-price loses that traffic as well.
Okay, so it's a double whammy, potentially less good stuff to sell, and fewer aspirational customers coming in the door.
That's the dynamic, yeah.
So who are the big U.S. players in off-price facing these headwinds?
Well, the main ones, the titans of the sector, really. TJX companies, that's ticker TJX.
TJX, parent of TJ Maxx, Marshalls.
Right. Then Ross Stores, ticker ROST.
ROST.
And Burlington, ticker BURL.
BURL.
Okay. All three of them generally do best when there's a bit of economic uncertainty pushing consumers to hunt for value, and crucially, when full-price retailers are struggling and generating lots of excess inventory. LVMH's success suggests the opposite kind of environment might be developing.
Okay, moving beyond off-price. How does this high-end rotation affect just, regular mid-tier clothing? Apparel basics, the stuff most people wear every day.
Here, the pressure is less about inventory supply and more just about, well, wallet share. Consumer priorities.
Okay.
If spending is rotating towards those premium goods, the fancy handbags, the expensive skincare we talked about, that money has to be allocated from somewhere. Often it means spending less on the basic everyday clothing items or mid-tier fashion.
So if you budget, say, $500 for clothes this quarter.
Right. And you decide to buy one really expensive, say $400 sweater from a premium brand.
Then you've only got $100 left for everything else.
Exactly. You might have to skip buying those couple of mid-tier shirts or basics you were planning on. You defer those purchases or just cancel them. The money gets redirected upwards towards the prestige item.
So which companies represent that mid-tier or basic segment that might lose out here?
You could look at companies with broad exposure to sort of consumer staples within apparel, maybe like VF Corp, ticker VFC.
VFC. They own Vans, North Face.
Right, a diverse portfolio, but still heavily reliant on mass market appeal for many of their brands. They feel shifts in broad consumer spending.
Okay. Anyone else? Maybe Levi Strauss, ticker LEVI. LEVI. Jeans, mostly.
Yeah, iconic products, obviously. But they're competing for that slice of the consumer's budget that could easily be diverted if someone decides they'd rather have a high-status luxury item instead. Buying new jeans might just feel less urgent when you're prioritizing a big aspirational purchase.
Got it. So VFC, LEVI, feeling the wallet share pressure. Okay, final category of potential losers. U.S. department stores and jewelry retailers. This sounds like maybe two different issues combined.
It is, yeah. They kind of face pressure from two sides in this kind of environment, which makes it particularly tough for them.
Okay, what's the first pressure?
The first is just the continuation of that prestige rotation trend. High-end spending, more and more, seems to be moving away from the general department store.
Even the ones with fancy shop-in-shops.
Even those, to some extent. The trend favors brand-specific boutiques or brands selling directly to consumers online, BTC. LVMH's strength sort of reinforces this idea that consumers seeking luxury often prefer the curated, controlled experience of the brand's own environment over a multi-brand department store floor.
So the department store just loses that high-spending customer's attention and foot traffic.
That's the risk, yes. They lose mind share for that really profitable customer segment.
Okay, that's pressure number one. What's the second one, especially for jewelry?
The second one hits jewelry retailers specifically, and it's about commodity costs, input costs.
You mean the price of gold, silver?
Exactly. Precious metals are the key raw materials for a lot of discretionary jewelry. If the market price of gold or silver goes up, that directly increases the cost for the jeweler to make or acquire their inventory.
And that squeezes their profit margins.
Right, it
Yep.
compresses their gross margins on these already high-value items.
So they're caught between maybe rising input costs on one side.
And on the other side, a consumer whose discretionary budget might be shifting towards that prestige handbag or skincare item instead of a generalized jewelry purchase from, say, a mall jeweler or department store counter. It creates a potential profit squeeze. It's hard to pass on those higher metal costs fully if consumers are already maybe thinking of extending their luxury budget elsewhere.
Okay, that makes sense. A tough spot. So which specific names might be feeling this dual pressure?
Well, for the department store challenges, you could point to Macy's, ticker M.
So heavily reliant on that traditional model.
Yes, reliant on general store traffic, housing lots of third-party brands. They feel it when spending shifts to mono-brand stores or online.
And for the jewelry side, with the commodity pressure.
There you'd look at Signet Jewelers, ticker SIG.
SIG. They own K, Zales.
Correct. Major mall jewelers. Their profit margins are directly sensitive to both where consumers choose to spend their discretionary dollars and also, very importantly, the underlying cost of the gold and silver they need for their inventory.
So their profitability really depends on balancing consumer appetite for jewelry against managing those potentially rising metal costs.
Exactly. It hinges on that balance and whether they can successfully hedge or pass on commodity price increases without losing sales volume. Hashtag tag outro.
Okay, so that really paints a picture of the potential winners and losers emerging from this LVMH report. If we summarize the main takeaway, LVMH's Q3 numbers, especially that confirmation of demand picking up again in mainland China, it's seen by the market as a positive signal for the whole high-end consumer segment.
Yeah, the market reads it as a forecast, essentially. A forecast that things are looking up for prestige categories globally.
And this perceived shift in spending has pretty direct implications for U.S. stocks, really depending on where they sit in the market, their brand positioning, their geographic exposure.
Absolutely. Companies focused on that top-tier consumer think luxury apparel, prestige beauty, maybe international travel plays like the Macau casinos, and the payment processors handling those big transactions, they're seen as likely beneficiaries. They might see better sales volume and maybe even more importantly, better profit margins if they can sell more at full price.
Right, but then the flip side. Businesses that cater more to the value shopper or the mid-tier consumer. Off-price stores, apparel basics companies, maybe the general department stores?
They could face some headwinds. That aspirational customer spending might be moving up market away from them. And for some, like the off-price guys, the supply of the discounted premium goods they rely on might shrink if full-price selling improves.
So it really highlights that dynamic, doesn't it? Growth in one part of retail, especially the high-end discretionary part, often puts pressure somewhere else. Money gets reallocated.
It really does. It underscores that critical balance in consumer spending. An expansion at the top end often means a tougher competitive environment for the value and mid-tier players who are fighting for that same wallet share. Understanding that rotation is pretty key to analyzing the broader retail landscape.
Well, this has been a really useful breakdown, tracing the potential impacts from one key report across the market. Thanks for walking us through that.
My pleasure. It shows how interconnected things are.
And just before we wrap up, we need to include our standard notice.
Right. This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.